It's Friday, everybody. The end of the week at last. Good morning to you all. Morning, Kay.
Good morning, Ryan. Good morning to everybody, TGIF.
Yep. A little public service screenshot you can see there. Just happened to pop up on my Twitter about passwords and stuff. So make sure you keep safe with all your passwords and stuff. Looking at that chart, I think I need to change quite a few of mine. But yeah, have a look at that. Obviously, keeping your stuff secure is tantamount in this day and age. So I thought I'd just point that out. Something a bit of fun for Friday. Where shall we go? Where shall we go?
So the best password is a dyslexic password with a lot of swearing and symbols.
Yeah, and the number 69 in it.
Oh, yeah.
Right, let's get into all the important stuff. Bit of a wild afternoon yesterday, markets, and again this morning, which we'll cross into in just a moment. Few bits and pieces out overnight, nothing huge. PBOC, they fixed the one up into the 680s, which could be a little bit significant there because we are seeing a break up in the one there. If we look at the offshore one, the one we can all trade, we can see we've had the break above the previous highs that we got earlier this week at sort of 81s, 82s. Look to be pushing on. I'm out my short, got stopped out my short overnight, 82.50 on the break, the full break of this line up here. I got a little bit of profit when we moved down, but I've given that back and a bit more on top on that trade. And K-Man's running this on the long side, so he's doing very well on that. I've seen some of the market tying the move in the one to the rest of the dollar strength elsewhere. I'm not sure that's that correlation is 100% secure. There's all part of a wider move in global markets that we're seeing at the moment, but we'll get into that in a moment. The RBNZ, Governor Orr was out again speaking about rates, nothing much more on top, mainly about the fact that rates are going high, is continually banging that drum. He said he wants them unambiguously higher, or unambiguously above neutral. So again, he wants those rates to keep heading higher and higher. On the data front, quickly, we'll look at what happened yesterday after the flow show. Initial jobless claims, a bit of a better number yesterday than we've been seeing the trend so far. We were looking at the 4-week average. That's a tad better. I'm not going to suggest that we're turning around what we've been seeing for the last few months, but maybe we're starting to go a bit sideways. We were speaking yesterday. If we start to see the number getting up about above the 400, maybe we'll see that filtering into the non-farm payrolls data and the other main jobs numbers. So a little bit of light relief. Let's see if it's a dead cat bounce or not. Philly Fed maybe was a bit surprising yesterday, particularly coming after Monday's Empire's collapse. Came in at positive where it was expected down 5.0. It came in at plus 6.2. Some of the other underlying components were a bit mixed. Employment was up a touch, but new orders were down, but not as bad as expected. Prices paid, so the inflationary component, softer as well. So a bit mixed in the numbers there, but so we've had one regional number that's shocking, one that's not as bad. It's just muddying the waters for the manufacturing sector as we go through the month. We'll see what the rest of the regionals come out like. We get the Dallas, Texas Fed, Richmond Fed manufacturing numbers as the days progress. Obviously, it all leads up to the big ISM, so there'll be the real numbers that we need to keep an eye on. But we'll look at these regional numbers just to see if we get an idea through the month. Is there a trend? But so far, we've had one up, one down. So it's a score draw at the moment. Existing home sales came in down 5.9%. As you can see on the numbers there, a little dip over last month. I was looking at the prices here, as I've been mentioning. The price numbers is what's going to be important for me. They dropped 10k from last month. but still well up over the year, up I think around 13% over last year's prices. But a dip on the month, again, going to be watching that trend to see if prices continue to come down. We have had some other data this morning. UK retails, let's have a look at that. There we go, there. A bit better than expected, really. The only thing I'll say about these is that these are unadjusted retail numbers. So again, if we factor in the inflation factors, the price factors, the story probably isn't as good. I couldn't find this morning the adjusted numbers to see what they were looking at. The ONS aren't very clear on their website, never have been, about that. But still, you know, as the market looked to the headline numbers, seeing better numbers there in the UK. We have seen a bit of higher pricing in some of the market for BOE rates. Yesterday, we saw the market sort of pricing in 3.50 or 3.5% of hike rate by March 2023. Some other players in the market this morning are thinking there's going to be another 200 pips of hikes by February, so that will put the rate at 3.75% by February, as opposed to yesterday's expectations of 3.5% by March. So a bit of a raise up there in BOE rate expectations. Not that there's been any effect in that in the quid. Some of the other news coming out, daily, a few central bankers yesterday from the Fed. Daily was sitting on the fence a bit over the 50, 75 basis point move for September. Says it's an open situation. Not committing at all. Going to wait and see what the data's like as she gets closer to the September meeting. Bullard was out leaning towards a 75 pip hike. George was out again and saying that it's not clear where the stopping point or hikes will be. And again, this is something that we were talking about yesterday, about how potentially that, you know, the market may get all a bit excited on when the Fed, you know, calm down on rate hikes, but it's where the rate hikes are going to finish, or where rates are going to finish is going to be the important question. And so George didn't really know where that stopping rate will be. As we know from the last dots, it's the high end is up in the 4%, 4.25%. We need to see if those get adjusted at the September meeting, and also to see whether rates are going to stay higher for longer. So we look at the 2024 projections as well in the dots to see if those are shifted up a bit, and maybe rates are going to get higher and stay higher for a bit longer, as has been indicated by some of the Fed members already. We've had a bit of heads up on, I'm going to use the term again as I did yesterday, Jackson's Hole. Powell's going to kick things off Friday afternoon or Friday morning in the US. It'll be afternoon here in the UK, with opening remarks to get things running there. The usual format is we get a ton of central bank speakers all the way through the days and weekends. The various news outlets set up their booths and stuff outside, and we get a lot of what we call doorstep interviews, where they get all the central bankers popping in and giving their views on top of what the official schedule is at the Hull. So that's stepping up. I thought we might get to into next week before that round starts kicking off, but obviously we're getting into it now. Just one other thing I want to point out, that a few stories doing around today about potential problems in the Ukraine at this nuclear plant that everyone's talking about, if I can get it right, the Zaporizhzhia nuclear plant. There are stories doing around that there's potentially an incident that's going to happen there. Part of the gamesmanship going on there, maybe something will go on there where some, I don't know, radiation is leaked or some incident occurs there. Both sides seemingly trying to play the same card. The Ukraine saying the Russia's going to do something like that. Russia saying the Ukraine's going to do something like that. The latest from Ukraine is that some of the Russian nuclear technicians that were working there have been pulled out. and they've been prompting in news-wise that there may be some sort of incident happening today. I think that's something that may be playing into a bit of risk. Obviously, it's a constant bubbling situation there, but that's just a bit of heightened risk potentially for today and maybe going into the weekend, and something in the Ukraine war situation that we need to keep an eye on around this nuclear plant. What we've also been seeing is Ukraine pushing a bit further into Russian-held territory. We've had that what they call sabotage attack on some of the ammunition depots in the Crimea. There's been some other explosions, I think late last night or this morning, in other Crimea parts. So it seems like there's something happening deeper into Russia or Russia-claimed territory at the moment. There is talk of an imminent counterattack by the Ukraine on some of the towns there. That could mean that we get some hotter news from that situation over the weekend. So keep that in mind for risk, because if Ukraine does mount a big counteroffensive, that could be met by Russia very strongly, and we get some increased headlines there. Obviously, a bubbling situation, it ebbs and flows, but we could get some increased headlines from that. Kay, I don't know if you've got any bits and pieces, news and stuff that you've seen overnight or this morning.
Well, the one thing that we have to keep in mind as well is that there's a big it's the stock options OPEX deadline today. I think it is today. So there's again, I mean, depending on who writes the story, it's $1-2 trillion expiring. But of course, I mean, we have to de-romance a little bit that story, because not all options are close to the money, and some of, likely most of them, are going to expire absolutely worthless. And but we'll have to keep an eye on what's happening in the equity markets today, especially this afternoon. So because there's rather than taking a direction, there may be a lot of whipsawing going on, and we've seen other months where we've got big OPEX expiries that the market is getting a little bit derailed by all of it, and we only see what's really happening in the market on the next Monday, and especially being a Friday, it's could be getting a bit volatile in the equity markets this afternoon. I'm putting the Bloomberg article in our chat box for those interested. So keep an eye on that. And then the other thing, unless you want to talk about it, were the Japanese CPI data.
Oh yeah, missed that one. I knew I forgot something.
Shall I run through them?
Well, I've got it up on the screen there.
Okay, go for it.
No, go ahead. I was just putting the
so it came out higher than the prior months, but as expected. There have been over the past week a lot of analysts coming out saying, calling exactly for these numbers. And so we were a bit higher, but the yen absolutely did not react to anything. And I think the main reason for that, it actually weakened further. But the main reason for that is not really, and people were asking the question whether BOJ would finally start to react to something. The BOJ is not really doing anything in between meetings, but I think next week Jackson Hole, I trust Kuroda will be around there as well, because he doesn't miss an occasion to go for a drink or two, and he'll probably comment a little bit on that, or we could have a few comments next week or so. But yeah, so it came out higher, and it is above the Bank of Japan's threshold. We did have Kuroda already saying that they want a prolonged period of CPI above their threshold to start to think about reacting about something. They are still the slowest of the bunch. They haven't even started to talk in meetings about whether they would or not start to scale back. On QE, they still have to start to talk about what and how it would look like. So we are not there yet. So the market has shrugged it off and continued to weaken the yen. And I will show a few pictures later, or if Ryan wants to show it in the dollar yen and stuff, we are at approaching very interesting levels there. But I come back to what I've been saying before, and I think the market now understood it, is that the government is doing part of the Bank of Japan's job in putting in more stimulus, more subsidies for high fuel costs and stuff like that. So somewhere it keeps Kuroda on his same line, because the government is doing part of his job, and actually by doing such a job is watering down the yen even more. With that, back over to you, Ryan.
Yeah, thanks, mate. What I'm gonna do is I'm gonna look up to see if we've got the full schedule yet for Jackson Hole next week, to see who's doing that. I'm looking at the site now, can't seem to find it just off the bat. There's nothing standing out on the main page. Yeah, I'm going to be honest. I'm in a bit of a flux over everything that's going on at the moment. It was been fairly steady during the week, fairly quiet, if you like. Not much movement anywhere, a few moves here and there, but you know, nothing massive. And then yesterday afternoon, you know, we started to get the dollar getting bid, yields moving up. That kicked on all through the night, and again this morning. Maybe it's just me back first week from being away. I'm not quite in the swing of things yet, but it's just I'm finding that there's so many different reasons and influences at the moment. For me, it's just becoming a bit hard to, you know, come in any particular morning, wake up, sit down and think, okay, the market's done this and this because of X, Y, Z. I'm just in that confused moment right now. So I've started, just before I started putting together the bits for the show, putting down just some thoughts on paper that I'll put in the chat room later, and I'm happy to get those discussed and have other people's input into those, just to see if I can get my head around things. Because, you know, you look at something like dollar yen, as Kay said there, you know, we've had this breakup. You know, we had a decent move down early in August, then it's moved up again, a bit of a refresh of the trend. I called this move here. And it has been heading high, and we couldn't break out of the 135, 50, 60 area. Now we've broken out. As we can see from yields, you know, we've got 10s pushing up near 3% again. You know, Dale's on the face has been going on about getting yields back up to 3%, and he looks like he may be well on its way. But again, the dollar is seemingly cleaning house. It's getting that strength in, and you know, we had one of our guys in the chat room today speaking about some funds who are coming in and they're getting on the back of some of these breaks, so it's adding a bit of impetus to it. But also there's a feeling that and we've been talking about it this week, some of the market who are always dovish about the Fed, thinking the Fed are going to pivot, they're going to signal, they're going to pause hikes or lower hikes, and when are they going to start cutting. And it seems some of the funds are now pushing against that via actual trading. So they're positioning for power, perhaps at Jackson Hole, to keep the Fed on the path and not give any inclination that they're ready to turn around yet. And that's something that I've been saying this week, that people in the market were thinking of dovishly about the Fed, thinking that anything that came out in the minutes were dovish. They potentially going to get spanked. I was thinking maybe this sort of move might start happening next week when we get the real ball rolling over Powell at Jackson Hole. But it looks like a lot of it is starting a bit today. That thinking that, taking the central bankers, the Fed are going to keep going, and they're going to keep going until they achieve what they want to achieve, and that's inflation lower. You know, if that means rates to 6%, that could be what we're facing. We don't know. Yes, at some point we know the Fed will stop. They can't really keep going at 75 pips every meeting. We know they're going to have to slow down at some point. We know they're going to have to let the effects of hikes come through. But I think the wider market is acknowledging that, and perhaps that's what's part of what we're seeing at the moment. I mean, yeah, we've got the OPEX and everything else happening as well, which could be causing some of these flows. We're still in summer markets. But what do you think for dollar yen, K? Do you think this is a proper breakout, or this is something that's...
Yeah, I'll show a little later. We just moved above the daily top of the top of the daily cloud as well. I've got a few levels up into the 137s as well. There's one just around here on the feed. I think it's the one that you are looking at there as well. But I've got a few levels up in the 137s. Well, it's as you say, right? I mean, the dollar is bit, and then you look at the other side of the yield spectrum, and we see Japan being the lowest one. I was just yesterday I was looking at, because we had for a while we had a bit of pressure on the top end of the Bank of Japan's target band, which is 25 BPs, now around 0. But we are like comfortably holding below lately, so that is likely to add to the pressure. I mean, the easy pressure on the yen, I would call it. I mean, nothing is easy. Trading is not easy, but it gives the yen bears something to rely on, because there's no pressure on the top end of the Bank of Japan band, where the rest of the yields are absolutely exploding. I'll show the European yields are pretty spectacular, and in that respect, it's a bit counterintuitive, and some correlation between European and US yields has completely broken down. Because European yields are actually rising much faster than the US are right now, but I think it's for the wrong reasons. So I'll come back to that a bit later. But yeah, on the dollar side, I can't agree more. We have been talking about it. We have been saying, and I've been banging on it for weeks, if not months, that the dollar isn't dead yet, and now all those people shouting that the Fed is close to a pivot, 2023 rates are going to start to come down because we are going to be in recession and stuff. We had, I think, 6 or 7 different speakers after the famous CPI PPI coming out saying that they are just going to continue, and none of them, absolutely zero, was talking about a possible rate cut in 2023. And I'd like to think that they have had some sort of, because everybody knows they first of all, they had some sort of agreement between all of them to prepare Powell's Jackson Hole. And I think that's where now the market, who was trying, well, some parts of the market who were trying to price in some kind of Fed pivot, are having to eat their words, or possibly even position, and they are forced into buying back dollars that they were likely short of, or selling back out bonds where they bought bonds because of the pivot, the possible pivot, and it may all end up in tears. And as a result, we have seen the dollar really move higher versus everything in the past 24, 36 hours, especially before that we were in like ranges, volatile perhaps ranges, but now we've clearly, in my opinion, taken a direction again. So it's too early for a pivot. And then the last thing, and I'm constantly repeating that as well, is that I'm curious. Worried is a big word, but I'm curious what's going to happen in September when the QT will double up, because I have the impression that those who are shouting and screaming about a Fed pivot will be the same people all of a sudden shouting and screaming and probably crying about the dollar liquidity when the reserves at the Fed will dry up. due to this QT. So and we have to be very careful going into September and autumn, in my opinion.
Yeah, there's always a bone that they need to have in their mouths over something negative. It's the market in a nutshell. You have the positives and you have the negatives camps. You know, you got the doves, as Kay says. They're banging on about when the Fed's going to turn, and then they'll move. If they don't get that, they'll move on to something else. And dollar liquidity, maybe the next bone they pick up. I did want to just jump back quickly to Japanese yields. It seems that, and maybe you've seen something different. It seems that the speculation that we saw a few weeks ago of traders pushing the buttons of the BOJ seems to have waned a bit. Do you think they've had that they've gone running away with their tails between their legs
I think
for the moment?
Yeah, I think partially that's
that's why we haven't seen a reaction in the yen over the CPI data.
No, I think that's partially the case, and then there was this. Well, it's just one or two articles saying that some foreigners are happily or are getting back into the Japanese bond market. It may be twofold. The reason, and maybe twofold, if that were to be the case, is that we saw a rally in the stock markets, Nikkei included. Nikkei went up how much? No, well, about 5% this month, and so that may be that people are buying a few bonds and then buying Nikkei and then on. But I also think the second reason may be that they understood that Kuroda was going to stand pat, so they buy back Japanese bonds but sell probably other bonds like U.S. and European bonds, because you can your risk to the downside in Japanese bonds is very limited.
Yeah.
But your possible or their suspected gains in foreign bonds being short is quite larger, right? Because the volatility is higher. So that the reason may have been twofold, but I'm taking a little bit of a chance there in with giving this kind of explanation. But it is sometimes the way the bond market and the investors' mind function, right? You won't get anything for your in return for placing money in Japan, because they are around zero. But if the rest and they think if the rest of the yield market is going higher, it might be a kind of a cross trade, right? It's a cross trade. You buy the one to sell the other. It all depends on their outlook, and I think that may be. And that or likely will be the case for these Japanese yields to have stopped pressing against the upper BOJ target range.
Yeah, exactly. Right, so let's have a look around some of the grounds. We've got obviously the break under 101 in the euro, down to, and it's pretty much sitting on this prior level at 100.70, which is where we were messing around beginning of July. You know, when we first got these moves down from the 105s, this was an area that became a little bit of a support and resistance point before we broke down to parity. And so it's shown up again. This is one of those times where a lot of business that happened over here is showing up again over here, hence why I've still got the lines in my chart. Another little area below there is down around sort of 40.50, so keep an eye on that too. If we get under this area, we're heading back down to parity again. It's going to be, I think, very key what happens down there. You know, you can't call this bounce off of parity strong at all. You know, 300 pips, it looks strong in terms of sort of intraday or short term, but you take it on, you look at the wider time frame, and you know, this bounce off of parity is pretty weak if you compare it to what's happened over the last year or so. So here we are. You know, we've broken out of this short-term range. We're sort of pinging 101s, 103s. We're having a look lower. It could be significant that we're holding this 10070 area. As I say, it's nothing more than a level that was a previous level last month. But the techs stand up for themselves, and when you look at levels, you know, this is what you want to see in the price action. So if we do get a move down, I expect we'll get a move down to parity. That, as I say, it's going to be very important there. If we hold that there again, then potentially we've got the possibility of bouncing more significantly, and even then taking out this area up here. Conversely, if we break, going to need to look at this prior low here. That looked to be a little bit of a flush move as opposed to a real move. A secondary move of break of parity here might be something more. So I'm going to be eyeing this level potentially for trying a long. I may think about reversing into a short if it breaks, because the possibility is that if it breaks this time, it's going to go properly. When that happens, I don't know. Obviously, we've got some risk headlines, as mentioned, with the Ukraine that might happen over the weekend. We are heading to Jackson Hole next week. If the Fed do stick to their guns and Powell gives a really strong message, we could see this level in trouble here. What do you think, Kate? Do you think we're going to do it? Do you think we're going to bust it, or is that going to be a line in the sand for us?
I was going to say keep talking. Since you started to talk, it's already 15 points lower.
Yeah,
it could be happening during the show at that speed. Well,
yeah, there we go on the shift.
So actually, I still can't buy a euro. People know it by now. I did scale back on euro crosses because I was a bit in doubt on how risk would pan out, and when risk is weak, euro crosses usually tend to strengthen somewhat, but it does seem to be a global phenomenon again now, where the dollar is strengthening and everything is going together. Euro crosses are not really moving that much, but dollars are being bought, and the euro dollar is already quite a bit lower again. I'm back in a few, but it's really scalping and jobbing on the short side of the euro dollar, because it does look like the dollar has really refound his mojo, and I would not be surprised if we retest parity later today, if rumors about funds and stuff are verified, that they feel uncomfortable with any dollar shorts. So yeah, I mean, those levels, the parity, the shakeout last time, and then I think we're still in the more medium term, the longer term, this 99. Which we have been showing a couple of times, is likely going to be very important as well. And I'll just repeat, sorry, for the people who were not yet listening or part of our community here on the show, is that 99, there is a really decent support there. I hope I can find it back on my charts, and it's still there. And it's very important, in my opinion, for a couple of reasons. If you look at the more medium term and for the longer term players, or for the momentum players, it's really, and it's been verified again last time we went sub parity. It's really there where the big decision is made, whether parity holds or the battle for parity is won or lost, in my opinion. It can go, as we have seen, it can go 50 points through and then rally 4 big figures, and as happened last time. But if 99 starts to go, then I think the people, the more medium-term thinkers, will really think that the battle for parity is lost, and we can go even deeper than that. So I think I still remain. I can't buy euros. I always try to be short euro in some form, because I think there's just too much weight hanging around the poor euro's neck. And but what levels are concerned, we always have to look at where the big important levels are. And to me, that 99, the figure is going to be the big one, whether the battle for parity is lost or won. If we get close to 99 and then start to rebound and get back above 1005070 again, I think then there's going to be a lot of running to be done on the other side.
Yeah. No, I think you agreed. And as much as I might look to trade parity, I might be inclined not to do so if we get a test today. If I can avoid holding a position over the weekend, I try to do that. I'd rather it test it on Monday when I can sit in front of my desk and see what happens and not have any weekend shock. But just quickly, before I let Kay take over the screens, very important what he said about the crosses. And this is something that we try and show a lot of inexperienced traders, particularly when they've come into my chat room and they've come into the ForexAnalytix platform, about how important it is to look at the crosses when you sit down first thing in the day, just to see which way the wind's blowing. Now, we know we've got dollar strength, but is there yen weakness? You know, what's the driver? You know, here we have cable under 120, under 119 now, euro dollar breaking down. You know, you look at something like euro sterling and it's not doing an awful lot. It's not doing a lot at all. Same with euro yen, not doing a lot. This is looking around at the crosses just for information purposes, even if you're not trading it, is always a good exercise just to find out where the pull and push is. You know, is it the dollar? And from that you can extrapolate and find out, well, what's moving the dollar then? But looking at crosses, even if you just trade the majors, is important to always understand, you know, what's potentially driving something at any one time. It just gives you that little bit of insight first thing as to where the market's moving. Here we can see Euro Swiss looking maybe more a bit of a risk off play, a safe haven flows. You know, that's again, it's still only, you know, 40-50 pips off. But you get a sense of what the market's doing there. And I know, I don't know if he's in this morning, our good friend Bran, he very much had his eyes open to looking at the crosses and what they can do in their pull and push for markets. Right, Kay, do you want to take the screens for a moment?
Yeah, sure. Okie dokie. Well, here we go. And the first one I really want to share. Yeah, Stephen, we'll come back on that. The first one I really want to share, just to show how correlations can break down rapidly and suddenly, actually, is this. That's the interest rate differential between the German and the US rates. As we can see on here, we have been range trading for quite a while, and look back at the euro dollar, we have been range trading for quite a while as well. So those two were correlated for a good amount of time, and then the day before yesterday, this thing started to break out, and then the euro dollar came a little bit backbeat, went back up to 102, just above 102, and then really, since the dollar market is in size bigger than anything else, US yields started to pick up and the dollar started to gain steam. But what we have seen over those two sessions, or the one session at least, when it really broke out, is that actually euro crosses were trading, were starting to pull higher, and that's where Euro Mex, Euro Canada, Euro Aussie, Euro Kiwi were all going higher, despite the euro dollar not moving at all. And today, even if the euro crosses are not doing an awful lot right now, yesterday evening, with the euro dollar correlation based on this has completely broken down. So I just want to highlight, if you are in correlation, and I'm looking at correlations a lot, there's always an element of uncertainty in everything that happens. So correlations work until they don't work anymore. And I just wanted to highlight this one today, because we have seen over the past 24, 36 hours that the correlation in euro dollar based on interest rate differentials broke down. So it's a little bit dangerous at times. I do have a fundamental reason for that, is that we are still struggling with the European economy, and at the same time we are seeing higher and higher CPI and PPI rates in Europe. The PPI coming out in Germany this morning hit a was it? Yeah, this morning they 37%, which is just getting ready for the next Olympic Games, trying to beat the pole vault world record there, and it's and actually, if you get high prices with an economy which is not really doing great or is at risk of still going into a tough winter, high CPIs, high PPIs are not necessarily bullish a currency, because it would put it pushes the yields higher a little bit, but they can actually become inversely a drag, because people need to pay more for stuff, and at the same time they need to pay more on the interest rates to borrow to pay for the stuff. So it can be actually a double whammy for a currency. But I just wanted to highlight this for a little bit. Now moving over, and I wanted to show the dollar yen. Let's first move on to the daily. You know, I've been trading off this cloud quite a bit. With some success of the low end of this cloud, and then yesterday into the Japanese CPI for some reason. I was looking dollar yen, Aussie yen, Kiwi yen, and all like doing pretty okay. But then we had this drop dollar yen down to what is it, 134.60s. I bought it there again, but then by the end of the European session, I just gave up, because it wasn't really going anywhere around 135.10. Half an hour later, the thing was trading 135.80. But just wanted to show the top of the cloud today comes in at 136.30. So ending the week and going into the start of next week in Japan, this could be an interesting one to watch out for. So keep it in mind. 136.30 close of the day. Should be relatively important. Closer to home, kill this because I never watch the Ishimoku. My Japanese sensei said watch on the daily, and the rest is just literature, or daily or longer. So on the day, then, as we see, we've broken above the whoops, here it is, the 135.5, which was the prior high. Was also a little bit of a fib and a prior high, prior low. Was a quite important level broken through in some fashion. Came to test this 136.60, which is the 78.6 of the 126, 139 rally, and now we are slowly grinding towards the 78.6 of the correction, down from 139 to 130, and there's a few trend lines converging there as well. So if we ever get a move up into the 137s, I'd pay close attention to what's happening in the 137.5 area. On the way down now, 136 the figure probably, and then the 135.5 is going to be a bit of a stop and go or stop or go level to me on the downside if ever we start to trade lower again. So we've got like a couple of big figures to play in if anybody finds him or herself brave enough to start to get either stand in front of or try to catch more of this move. Personally, I've got nothing right now, and I'm really watching the game. On the euro dollar, I'm going to try to find this. See if I still got it. Here it is. So 99, the figure. We've been showing this earlier, and even over F.A.C.E and even before we started this flow show, I've been showing it on in our chat room. 99, the figure is 78.6% of the whole move higher from 82 to 160. So it's, to me, not only psychological, but it's also a fib level, and it's going to be monster important if ever we get down there, because it's also, if you look at it, okay, give and take 30, 40 points in a long-term chart, it doesn't mean much. But we've seen this first rally higher, then a setback, then we started to top here for a while, and then finally it was the start of the springboard for the whole move higher as well. So if ever it comes down there, watch this 99. To me, is going to be mega important. Closer to home, broken below the 102.10 here, which was holding retest the other day, and it's failing, and finally the weight has become a little bit too heavy, and together with the rest of the dollars, the euro has suffered as well. And okay, there's a bit of a level here to me around 10040, and then we're on to the prior lows really. And as there's a bit of a trend line here as well coming in from a longer time ago. So this 99.50 is one to keep an eye on as well. But as Ryan already mentioned, parity is always psychologically important. So there should be increased activity if we reach parity. Top side, yesterday and on prior shows, F.A.C.E as well, Blake has been banging on about this 101.10 level, which was a 61.8 of the move up from below parity to 103.50.70. So 101.10, we can add 101.20, 30. So this, let's call it the 101.10.30 zone, is going to be important on the top side, because if we start to get above again without managing to get down to parity or below, it could mean technically that we are in a failure territory, and we'd have a chance to get back 150 points higher. That is the technical part of it. If ever we start to get back above 101.10.30, I would not like to be short in the short term. Move over to, let's have a look at the metals. Yeah, they've undergone the laws of gravity as well, and I said it was a bit of a risk since we couldn't make fresh highs through this 1804-05 zone in gold. It was a bit of a risk that we would go back into a more defensive mode. That's where we are now. I think the 47, 44, 47 zone is one to keep an eye on for the rest of the day. If the dollar really picks up speed, why not go get down back to 17 and a quarter or so? We will need to see a reversal in the dollar, and especially a reversal in yields, I reckon, to have a chance for the metals to ramp back higher. I've got to say, I mean, I'm not ultra bearish on the metals either, because the economic data are slowing, and yes, technicals are calling for some form of recession. I call it rather setbacks to the big explosion. As I've been saying many times, we are in very accelerated economic cycles right now, and they can flip around on a dime as well. So if we continue to get better economic data, yes, yields will hold up, but metals may start to bottom out and find a way to go back higher. Especially this one, I think, silver. I've been catching a couple of knives again, because for the listeners who know, I was long here, and I've loaded virtually everything here. So yesterday I bought some around 1980, then I've got some around here 1953. I bailed out on some on the break of these, because I just don't feel too confident that the dollar is done doing so. gave back a little bit of what I made here, and I'm going back to more of a core position, core long position. I do think in the very, very long term that this thing is trying to probably even go further than that. I do think that we are there's a good chance that we're holding these levels and then round and start to go higher. The big risk is still, and that's why I never get too confident. Is that what happens with the quantitative tightening in September? Because there could be some dollar liquidity issues coming up, and we have to be a bit careful with that. So that's why I'm keeping everything under control, especially risk and amount wise. I'm keeping it really on the defensive for now. What else? Yeah, I was short Euro Canada, and this morning I was I'm not too sure. So it's been doing nicely. As the people know in the chat room, I've been up and down in this one, jobbing it around, trading it off this 130, 160, legs up, legs down. And today I'm not sure about risk, so I prefer to take the rest of the profit and enjoy a bit of a quieter Friday. I'm not saying it's not going to go down. I actually think it will continue to go down, but this Friday, if they want to take it lower, unless we start to break below 130.30 and 130 the figure, I'm not going to be too tempted to have much in it. If we ever see a rally, which would be probably risk of induced, I might start to give it a try again from same levels of from around 131.20 up to 131.60, and I might start to leg into it again, but I will keep the risk and then the amounts very, very low. There's another one where I gave it a try and I bailed. I thought this range in the Euro Kiwi had a chance to give way overnight, especially with ore still not giving much for the more dovish side, and looking at the euro coming off, I thought the Kiwi was going to behave a bit better than it did. So I tried a short here, but then I quickly bailed back above 130.160. So that on a small one, I took a small loss on there, but that's been covered with the longs that I had on the Kiwi yen and the Aussie yen. So on the Kiwi yen, I bought it around here, and then I let it go earlier today. That really covered the euro Kiwi losses. On the Aussie yen, it's been a bit more successful. I was also lurking at this level, but I started, since I was long dollar yen, I used a part of it to and I bought Aussie dollar yesterday against it around 69.30, of which I sold a part at on the rally to 69.60. So that put me long on average around because it weren't equal parts. So it put me average long around 69.10 with the dollar yen that I had around 134.90. And I took the profit this morning here actually between 94.25 and 35 on the Aussie yen. Just because I want to have a relaxing day and a day of reflection on what's to happen later today and possibly into next week. But just know that I'm still positively biased on these. If we get a setback, I wouldn't mind to start to get back legging in down to 93 figure-ish on the Aussie yen, and likely around same kind of thing, or anywhere between 84.25 and 84.5 looks to be relatively interesting for the time being. We had quite a few questions about the euro yen. I'm going to say honestly, I don't have any interest in the euro yen right now because I'm equally bearish on both. So then in that case, I gladly leave the cross alone. But people are seeing an inverse head and shoulder building here. Either you put the neckline at 137.80s or if you take this one, it might have broken already, but I'm really not going to trade it. It can really go anywhere. If the dollar rises, and I'm going to answer Stephen's question about the crosses as well. There's something to keep in mind, and why I told you that those euro crosses were beat the other session. When the dollar is rising, there's two factors. Usually, it's a bit of there's a bit of risk. There's possibly a bit of risk of in the mix with all the yields. So let's forget about the yields for a second. And there's possibly there's two reasons why euro crosses can go higher in a risk off or in a dollar buying environment. First of all, is that when it's risk off, people tend to get out of more volatile assets and go back into less volatile assets. And euro being the other big block compared to the dollar, and seeing like a stable kind of assets, sometimes we see this acceleration on other currency pairs versus the euro dollar for this reason, but also for the reason of liquidity. The euro dollar FX pair is the deepest liquid pair we can find on earth, right? There's no more liquidity anywhere else than in euro dollar. There's trillions, at least a few trillions of the $5 trillion market going through euro dollar every day. So it makes sense that if the dollar is beat, other currency pairs will go faster just because there's less liquidity. And the second factor is that is this retrenchment in a little bit more safe assets. And the euro is likely to benefit a little bit more about that per correlation than we see the yen for now, because the yen has completely thrown away the risk correlation over the past months. Yen, if you want to trade dollar yen, just look at the 10-year yields in the US dollar, and that's where the dollar yen is heading, 95% out of the time. And 5% of the time it correlates again with risk, but most of the time it's purely correlated with the 10-year dollar yields. And I think that's enough for me for one day, Ryan.
Yeah, no worries, mate, and good explanation on the crosses. The main exercise for it really is if, for example, you sit down in the morning, you see something moved. It's the question we all ask: why? Why has something moved? Why has euro dollar moved? Why has dollar yen moved? And so you just go through the little exercises. First thing, there's obviously two sides to a pair. So if you see euro dollar, that's the first thing you look at, and you see euro dollar on its lows and moved 100 pips overnight or whatever. The first question you ask is why, and then you do the exercise to look around. Is it the euro? Is it the dollar? If it's the dollar, you'll see other dollar pairs moving. If it's the euro, you'll see other euro pairs moving, and that's why we look around the crosses and we just do that exercise. Just so you got an idea what has moved what in any particular time. Then it can set you up for the day. You know that your path of least resistance, or you know what the market's got to do to turn around. But anyway, that's that for this week. Bit of a quiet one on the data docket, so and on the speakers docket as far as I can see as well. Just got Canada retail sales later on, and that's it for the day as far as I can see. No Fed speakers of any massive note. I know we've got one out, but let me just double check. We've got Barking out later today, riding the wave. Maryland's economic forecasting stormy seas, or whatever. That should be a throbber. Anyway, thank you very much for coming to today's show and all this week. I hope it's been a good week for you. Have a very safe and peaceful weekend, and we shall see you all on Monday when we go again and we get the run up to Jackson's Hole. So have a great weekend, everyone. Thanks, Kay.
Have a
See you
great
all soon.
weekend. Thanks, Ryan. Thanks everybody for listening to us, and every day. It's a real pleasure. Don't forget to make our publicity. The more, the merrier.